Welcome back to the Macro Real Invest channel. Today I have the huge pleasure to have here together with Martin, who you know already, also Louis-Vincent Gave, big name in our industry. It's an absolutely honor that you're also joining our discussions here. We used to have also with Martin. So my name is Zoltan Szelyes. I'm a macro real estate strategist and more known in Switzerland in real estate and macro. But I would like to give the word over to you, to Martin, to lead our conversation today.
So we have the pleasure to have today Louis-Vincent Gave, the CEO of the maverick macro firm of Gavekal. It's quite interesting for me because the first time I've came across Gavekal Research was back in the days in 2006 at Bank of America. We had prop traders who were followers of Gavekal, so I came across Gavekal Research at that time. And it's quite interesting because two of these guys, it's like a tiger management. They left Bank of America. One is Simon White, macro strategist for Bloomberg. The other one is Jonathan Tepper, who set up Variant Perception. But everything started with Gavekal for me in 2006 when I came across their research. And before that, I had read, of course, Charles Gave, Louise Favor's book, Des Lions menés par des ânes, which was a great initiation for me to the world of macro. So
you're dating yourself.
Sorry?
You're dating yourself.
Exactly. Yes. I have less hair than you, but they're getting white as well. Zoltan as well. We're getting old, but it's a great pleasure to have you on board. To discuss a few subjects, which you are of course an expert. And I think I'll let Zoltan ask you the first questions of what we would like to discuss with you during this conversation.
Before the questions, thank you so much for having me on your podcast, guys. I'm very flattered for the invitation, and I'm very, very flattered by the introduction. If only half of it is true, then I've done well. So thanks again for having me.
No, thank you so much for taking the time. We really appreciate that. So Zoltan, if you want to kick off.
Yeah, people know me as a contrarian, and while everybody's focusing on Hormuz, I asked the first question on China because it's losing a bit attention. But I'm also, as an investor into China, I'm still also following it. And if I have you here, Louis, also with that experience, I would like to ask the question, how do you see the Chinese economy? How is the rebalancing to the consumer-led progressing there? How do you see it?
The rebalancing is going slowly at best. It's been, I think, on growth. If you look just at the growth numbers, this year has been disappointing, so it's all the more surprising, I would say, that I think if you take a step back, you would think that China right now should be going gangbusters, because China today has the lowest cost of electricity in the world, after all the investments they made over 20 years. They have the lowest cost of capital. Even as bond yields today, before we started, Martin and I were talking about bond yields are breaking 470, etc. China is the one place in the world where bond yields continue to go down. Cost of capital is the lowest in the world. And then finally, if you adjust it for productivity, the cost of labor is the lowest in the world as well. So you would think with cheapest cost of electricity, cheapest cost of capital, cheapest cost of labor, the place would be going absolutely gangbusters, but it's not. Exports have been doing great, I guess reflecting how competitive China is. But domestically, I think we're still living through two hangovers. The first hangover, of course, is the real estate contraction and the consequent balance sheet recession. So that's one issue. And the other issue we're dealing with is that consumer and business confidence are in the doldrums. They've been absolutely crushed by a number of decisions taken over the years. But the overarching theme of China, really for the past 10 years, has been the leadership's effort to de-Westernize its supply chains. I think the leadership was deeply, deeply disturbed when in 2018, the US blocked semiconductor access to China. I think this was a huge scare for them. They thought if they can block semiconductors, maybe the US tomorrow blocks, I don't know, chemical products or car tires or anything. And they felt the need to become self-sufficient in everything. And so for really 8 years, all of the bank lending went into that national effort to become self-sufficient in everything. Now, the good news is for them, they're pretty much there. But in that process, you've essentially destroyed consumer confidence, who for 8 years didn't really have access to credit because all of China's savings, which happened to be enormous, were redirected towards building a car supply chain, building an electricity generation supply chain, et cetera, et cetera. And so I think we're still dealing with the hangover of all of this. I think China's in a good spot to keep thriving economically, but we have to acknowledge that the numbers this year are not that great.
Yeah, and a question I have to ask you, because it seems to me when we look at housing affordability for China, it's gone back 20 years back. So
Yes.
housing affordability in China is again at the right level, it seems. Because
That's
of,
right.
and if you add to this the factor that, as you mentioned, like the cost of the energy has come down drastically, it should create additional boost for the Chinese consumers. And the questions we're getting from a lot of family offices is, when are we going to see some rebalancing to consumption? And it's quite interesting because we get these questions from US-based family offices, which are used to seeing the US GDP made of 70% of GDP. And obviously
Of
China, it's
consumption. Yeah.
absolutely, not the case. So what do you make of this?
I think there's two separate. If I can break down your question in two, the first part is the real estate bit, and I think there's increasing signs of stabilization in real estate. Not really rebound, but at least in the major cities, you've seen the high end come back in places like Shanghai, Hangzhou. You've seen the high end come back. The low and the middle end stabilize. This is true for the big cities. It's a lot less true for your third tier cities, cities with 5 million people that you and I have never heard of. And in those cities, you're still left with probably excess capacity that has yet to be wrought through. And as you point out, this means that, prices have come down a fair amount. Pick your city, prices are down anywhere between a third and half. And yes, affordability is now much, much better. So you would expect, given this, that consumption would thus pick up. And here, I think what you're finding in China is very diverging trends depending on the generations. And essentially, if you look at your Gen Xers, if you look at your baby boomers, those guys are actually doing fine. They bought real estate 30 years ago, and yes, their real estate has come down, but their balance sheet still looks pristine because from where they bought, real estate has come up so much. If you look at the millennials, and to somewhat of a lesser extent the Gen Z, those guys are obviously the ones whose balance sheets got totally destroyed by real estate going down 30 to 50%. And at the same time, those guys typically haven't had a wage increase for 10 years. And they're the guys who are now being told, look, your job is going to be lost to AI at the same time. So if you think of these three messages together, first, my balance sheet get destroyed. Second, I have no wage increase. Third, I'm being told I'm going to lose my job. None of that is very conducive to booming consumer confidence. None of that is very conducive to people going out on a limb. And so I think the fact that essentially millennials have really carried the burden for China's real estate adjustment, but also for China's shift away from property-driven growth to having all of China's savings mobilized and pushed into this effort of de-Westernization of supply chains, because that's what it is. Millennials have carried both of these burdens. It means that they're the guys who've tightened their belt. And the easiest way you see this is in first the marriage rate, which has plummeted, and with that, the birth rate, which has really, really plummeted in the past 5 years. And I think this is what's driving the shift in policies in China now, is the extent to which the policymakers now have to react to the fact that Chinese people are no longer getting married and no longer having kids. I think that's, if 10 years ago, the number one concern of Chinese policymakers was the US is out to get me, I have to cushion my economy against potential US attacks. Fast forward to today, and now the concern is, well, if we don't turn around these demographic trends, in 75 years, we won't have a country. Like in 75 years, there'll be nobody left. We'll have built this awesome infrastructure. We'll have built these great roads, these great railroads, these ports, these power plants, and there'll be nobody here. So that this is now, I think, the shift in policy going on. And it's a hard shift, because how do you convince people to get married and have kids? And by the way, it's not just China that's struggling with it. Korea is having the same issue.
Yeah,
Japan,
South Korea. It's dramatic.
Western Europe, in large parts. So it's not unique to China. Having said that, the pace of deterioration in the past 5 years is unique to China. I think everybody was sort of, if you look at the birth rates, everybody was sort of on the same downward slide, more or less. And then in China, it fell off a cliff. It absolutely fell off a cliff in the past 5 years.
According to your assessment, are they more open to migration than like the Japanese, for example?
So I think migration in East Asia in general is very hard. First, there's a huge language barrier. And learning Japanese, learning Chinese is hard. So for immigrants, that's the first hurdle. Secondly, I think when you look at China, the country is so big. It's like the numbers are so big. Like, are they going to take 100 million immigrants?
The numbers cannot add up.
Like, you guys, I know Zoltan, I know you live in Switzerland, and I know you guys just had a referendum as to whether to go past 10 million people, and whether
it was
to
a
block
big discussion here.
black immigration. 10 million people is the size of a city you've never heard of in China, to put things in context. So if you're going to solve this problem through immigration, you got to bring in 100 million. The numbers don't work. It's just too big.
And as well, we've seen some trend about repatriation, some top scientists, scholars relocating to China, which I thought was quite interesting from the research advantage the US had by attracting talent and retaining talent. So it seems like there's some kind of shift of Chinese relocating back to the homeland. What do you make of this?
That there is. Now, I don't think it can be enough to shift the demographic issue, but economically it's super important. And it can be super important in terms of specific industries. If you take, for example, biotech. Biotech is the one sector that has benefited tremendously from this. Essentially, 10 years ago, there was really no biotech industry in China. Now, you mentioned like 5 minutes ago how China is now more affordable to live in.
Yes.
It's not that China's affordable, it's that it's a raging bargain. And I invite all of your listeners, if they want a cheap holiday, to go to China. You get to stay in 5-star hotels. I mean, world-class hotels with terrific service. You get to have some of the best meals you've had in your life because the quality of restaurants in China has gone up so much in 20 years. And all this for a fourth, a fifth, a tenth of what you would pay in the Western world. And so, to your point, I think if you're an American-born Chinese, a Canadian-born Chinese, or a Chinese that was born in China, moved to the US for job opportunities, for studies, you got a PhD in biochemistry or whatever, you worked at a US firm, you can now move back to China and make almost as much money, but your cost of living is really a fraction of what it is in the US. And so yes, there have been people coming back that have helped China. China's been on this big effort for the past 10 years of closing the gap with the US, with Europe, on industry after industry. Essentially, and biotech being one, semiconductors being the obvious other, obviously electric vehicles and so on. And I think what you've witnessed really in the past 5 years, and most people have missed this because nobody visits China anymore. Everybody says, "Oh, China, it's uninvestable. It's a bear market. It's a balance sheet recession.
We heard that
I'm not interested." What they missed by not going, they missed two things. First, they missed the best performing bond market in the world for the past 10 years, 5 years, 3 years, 2 years, 1 year, 6 months. Pick any meaningful time frame except for the past 24 hours. And China has been crushing every bond market in the world. So first, people missed that. Secondly, I think people missed the fact that when it came to essentially anything linked to transportation outside of jet planes, anything linked to electricity generation transmission, anything linked to telecoms, and anything linked to factory automation and robotics, it's not that China was catching up with the Western world. They've actually leapfrogged the Western world. And they're now ahead. And people are starting to realize it as they see the Chinese cars arrive on their streets, and they see the BYDs, and they're like, wait, what happened here? Like, this car's actually pretty sweet.
Absolutely. But it's not only BYD, because I noticed something quite significant. It's like recently you had the Emirates who canceled their order for the new Boeing 777 because of the delays, because of many factors in the production of this new airplane from Boeing. And China has been investing massively in airlines, building their own COMAC. And it looks like they're really prime in moving up the value chain, not only on biotech, not only on cars, but now they're attacking the segment of airplanes, which is quite significant, I think, for the entire region of Asia.
It is massively important. It's all the more, look, airplane manufacturing has been a duopoly for our whole lives.
Yes.
At least the big ones. It's been a duopoly for our whole lives. And it's an industry that likely is going to be in shortage actually for years to come, because demand growth in emerging markets for planes remains super strong. And the ability of Airbus and Boeing to produce in time, as you point out, Emirates canceled Boeing because those 777s kept being pushed back.
Yes, exactly.
Now, so China, the COMAC, China is now doing single lane airplanes. And sort of, short to mid range. The ability to do a two lane airplane, the bigger airplanes that can go 15 hours, that's extremely challenging. And it should also be highlighted that when you look at the COMAC, I think almost 50%, I think it's like 45% of the parts still come from the West. So aeronautics is one of the areas, I think, where the Western world still has a pretty strong comparative advantage, where we still have, technologically, we're still quite ahead. Like, building big planes safely is extremely, extremely challenging.
Yeah, exactly.
It can't be something approximative. You build a car, and if one car out of 1,000 breaks down and ends up on the side of the road to be towed by it's not that big a deal.
No.
But planes are tough. Planes are very tough.
It's quite interesting to see that, the baton gets moved around. And I was reading recently as well that both Cambodia and Vietnam, for example, they are picking up in the textile business from China. So it seems like the baton gets moved around. China is moving up the value chain. Yet when you look at the performance of the tech sector, for example, for China, you had some people saying early 2025 that, China was uninvestable. And you had a huge rally during the whole course of 2025. Now, since the beginning of the year, Chinese tech has been struggling. And as recently discussed, you have yet another DeepSeek moment being discussed around Moonshot, where Alibaba is as well a large shareholder of Moonshot. They own 35%. So what do you make about two things? The disappointing performance of tech in a very ultra competitive environment, on top of the very high disposable savings of the Chinese population when you think about that, Trump came along in his last visit to China with all the top financial guys, the BlackRock, the Blackstone, the Goldman Sachs. They all came across to China, say, well, hey, guys, why don't you open up your financial markets? Because it looks like you have deep pockets. So what do you make of all of this? Oh,
You're still on mute.
yes, you're on mute.
Sorry about this. I muted myself so you wouldn't have background noise. Sorry about that. The great questions. I think I'll kick off with the tech, which has been fascinating, because to some extent, I think when Westerners look at Chinese tech, indeed the default mode is to say, oh, let's look at Baba, let's look at Tencent, let's look at Pinduoduo, Meituan, all the JD.com and Baidu, all the huge, essentially internet platforms that are listed in Hong Kong.
Yes.
And that's undeniably one part of the tech world. And that part of the tech world has been sucking wind terribly.
Yes.
It's been really, really struggling. What's fascinating, and you see this is reflected in the performance of the Hang Seng Index, which again is how most people judge how China's doing. What's been fascinating this year has been the divergence between Hong Kong on the one hand, Shenzhen stock market, and Shanghai stock market. Hong Kong's been a dog with fleas, and Shenzhen and Shanghai have just powered ahead. And I think what you're witnessing in China in tech is actually not that dissimilar to what you've witnessed in the United States this year, in that anything linked to hardware has really crushed it in China, just like anything linked to hardware in the US has also crushed it. Meanwhile, if you take anything linked to software in the United States, or even the big internet platforms, etc., it really hasn't done that great. So
would you say it's like a reverse 90s where like in the 90s it was all about hardware? You had the IBM, you had the Dells, you had the start of Apple, and then came the software, the Microsoft, all these guys, the Google, the software. Are we switching again to that kind of stuff?
Yeah, I don't know. I think right now the perception of the market has been, look, this AI is going to increase CapEx massively for years to come. I don't know if that's true, by the way, but I'm just saying that's the market's perception.
Yes.
AI is going to increase CapEx in hardware for massively for the next 5 years. There's not enough capacity of producing disks and producing semiconductors and producing, so on and so forth. And that therefore, all these guys get bid up on like, oh my God, there's not going to be enough for everyone. And the prices go up, semi prices have gone through the roof. And then the guys who actually have to buy this stuff, i.e., the Microsoft, the Salesforce.com, the Intuits, the Alibabas, the Tencents, they're perceived as the victims. It's like, oh, they're going to have to pay more to get less. And at the same time, the guys who wake up in the morning and think, oh, I don't own enough Samsung Electronics, I don't own enough TSMC, I don't own enough SK Hynix. You have to sell something to buy that, right? And the natural thing is, okay, I'll sell my Baba and Tencent and I'll buy SK Hynix. And so this year you've had $120 billion of outflow out of Hong Kong, mostly out of those big names. Even as those guys have actually, now there is one massive difference between, I would say, the Hong Kong listed tech and the US tech that has been doing badly. And that is that the US tech that has been doing badly, the Oracle, the Salesforce, etc., these guys for years were shrinking their share count, but they're no longer shrinking their share count. They're now actually increasing their share count. We just saw Google issue $85 billion of stock, and Meta is going to be doing the same, and so on. In China, you look at Baba, you look at Tencent, they've now started to shrink their share count.
Yeah, which is quite interesting because they're doing not only buybacks, but it looks as well that Alibaba has been really restructuring its own labyrinth of all ownership, of all participations, and a lot of companies. And I think something which is a little bit missing out of the perspective of the investors when looking at Alibaba is the fact that they're looking at creating their own chips, like a RISC-V. which will be in direct competition with the likes of Nvidia. So everything can happen on that. And
don't put a coin in my Baba machine or I'll be off, because that's one of my biggest positions. No, look, so the bottom line for tech in China is the hardware stuff has done very well and the non-hardware stuff has done badly. And so it's just like the West. It's been exactly the same trend. It's just that if you look at the Hong Kong stock market, the Hong Kong stock market has a lot of the non-hardware stuff, and Shanghai and Shenzhen have a lot of the hardware stuff. So Shenzhen is up like whatever it is, 45% in the past 12 months, and the Hang Seng is down in the past 12 months. So you've had this divergence, which is not that dissimilar to what you've seen in the West.
That's very interesting.
That's quite interesting. I haven't heard that story yet. So, but we don't know so much of China here, and we don't hear this specific story. So it's quite
and moving
amazing.
back to the China and the aging population. Obviously, we've read that the Chinese government is looking at providing more social health care, social protection to the population because of aging concerns. As well, we've seen that the government has been coming into support very recently to the tech sector, buying into the market. What do you make about how the Chinese government is going to help in maybe reallocating some of the savings into their own equity sector? Because it seems to me that they were quite happy about having all the Westerners leaving the country and opening up more of the stock markets to their domestic investors. I don't know if I'm wrong on that or not.
Yeah. I think one of the frustrations of doing China is that very often it feels like it's 3 steps forward, 2 steps back. And this is the case on many fronts, but it's especially the case on financial deregulation. And you mentioned financial deregulation earlier, and I think this is another big component of understanding what's happened in the Hong Kong stock market. Because to your point, I think there was this feeling of, and especially after Trump's visit, of, they got BlackRock in, like you said, and they got Blackstone, and they got all the boys came in. And so there was a bit of enthusiasm of like, okay, good. We're entering a new phase of financial deregulation. And on the back of this, it was actually interesting because, what was it, like a month later or 6 weeks later, China turns around and slaps not massive, not like fines that are going to kill them, but big enough fines on a bunch of the small local brokers, people like Tiger Global, people like Futu.
Yes.
It slapped big fines because those guys were essentially helping Chinese people circumvent capital controls, get their money into Hong Kong, and then from Hong Kong into US equities or whatever else. And when the government did this, I think everybody was very afraid, thinking, my God, this is the first salvo. HSBC, AIA, Ping An Insurance, Standard Chartered, they're all next. Because, by the way, everybody's been doing this. Everybody's been finding ways to get Chinese money out of China and put elsewhere. Because it was a very lucrative thing to do. Just like in the 50s, 60s, and 70s, Swiss private banks took all the German and French money and helped rich French Chinese people hide their money in Switzerland. That was a super lucrative thing for Swiss banks. Essentially, all the Hong Kong financial players were doing this. And so when they slapped a big fine on Futu, now what was interesting is they could have killed those companies. They could have said, hey, you guys broke the law. We're revoking your licenses. You're done. See you. Goodbye. They didn't do that. They slapped fines that were big enough to hurt. I mean, like a couple $100 million. Big enough to hurt, but not big enough to kill the businesses. And they also didn't take away their licenses. So to some extent, it was a sort of warning shot, like, stop doing this. Like we don't want this to happen anymore. Like we don't want this capital outflow, which I think has been one of the drags of on the Hong Kong stock market. It's like all of a sudden the Chinese money stopped coming in. The Chinese money stayed inside China, so the Hong Kong stocks did. The Chinese stocks did well. The Hong Kong stocks did badly. And now they turn around and they say, you know what, we're going to increase the southbound connect. The southbound connect is essentially the legal way through which the money can flow from north to south. And since they've done that, about 2 weeks ago, the Hong Kong stock market's been bouncing back.
Yes, we've seen that with Alibaba bouncing very significantly.
Yeah,
in the
25%,
last
etc.
Yeah.
So
yeah, absolutely.
So I think there was this phase of from May to about 10 days ago, 2 weeks ago, it's like, oh my God, China's going to prevent all the money from leaving. And now it looks actually, they're not going to prevent the money from leaving. But they want to put bigger guardrails around it. And that comes back, I think, to what Xi Jinping really is that deep down, he's a bit of a control freak, and he wants to control things. And this is especially true when it comes to financial matters and when it comes to the money. They might not be opposed per se to money leaving, but they want to know where it is, when it is, who has it, what it's doing. They want to know all these things. And so that's where we are.
Yeah, because it seems to me from an outside view, it's all about, I guess, harmony, maintaining stability, whatever the cost. And whenever people get too enthusiastic into one thing, the government comes in and clamps down. Like we've seen it in 2017 with the Chinese government coming very hard on the wealth management product. We've seen it after that when the Chinese government decided that the real estate speculation was out of control and it had to be stopped. So they clamped down on that. You had all the big US funds complaining that they were not bailouts, which is what capitalism is all about. So sorry, guys. Sorry for the Fidelity, the Templetons, who had like large bond holdings on Evergreen and all these guys, but they got wiped out. But yeah, that's a risk you take. Like if you're an investor, that's the way it should work. So everyone was a bit of surprise there was no bailout because people have been used to so many bailouts. But yeah, as you mentioned, the clamp down on the brokerage seems to me like it's always about not only, I think, all about controlling the flows, but also maintaining there's some stability somewhat and that it doesn't get out of hand regardless.
Look, the first time they really did it was in 2015 when the stock market went parabolic up and they absolutely stepped on it and brought it back down. They said, okay, no more margin trading accounts, no more. So yeah, you're right. There was 2015, 2017, 2018. And that comes down to what I think is the true North Star of Chinese policymakers. When you look at China and you start to wonder, why are they doing this? Why are they doing that? What's the goal of the policy here? Their true North Star remains always social stability.
Yes, exactly.
The Chinese leadership is first, most people think they're in the game of maximizing GDP growth or no. They're in the game of ensuring social stability. And this is a reflection of China's own history. I think we have to acknowledge that between 1850 and 1975, China was one of the most miserable places to live in the world. It had famines, foreign invasions, the opium wars. It's estimated that you had a fifth of Chinese males addicted to opium in the late 19th century. China was, it was a very, very tough century for China. And so on the back of this, social stability comes at a huge premium. If this has been in your history we always go around saying, the Germans, they're always against inflation because of hyperinflation of the 1920s, which led to fascism, etc.
Yes.
China also had a bout of hyperinflation post-World War II, which allowed the Chinese Communist Party to take over. And China is just as much of an inflation hawk as Germany, which is why Chinese bonds do very well. I've argued many times that the PBOC is the new Bundesbank, and
that's very interesting.
And Chinese government bonds are the new German bunds. Now that German bunds don't exist anymore, but if your history was 125 years of foreign invasion, famines, anarchy, social breakdowns, etc., for you as well, social stability would come at a huge premium. So this is their shining star, and yes. Anything that might threaten this social stability is quashed.
Yeah, that's what I thought I was gathering from looking at the different episodes where they seriously clamp down on anything that could be seen as being out of hand and creating some very very potential risk for social stability. They would come like all guns blazing and just destroy, doing a controlled demolition, or just basically stop it in its tracks. Like, no, we're not going to get a casino on the financial markets. If you own the casino, you already have Macau. You can go there, enjoy yourself. But we're not putting at risk social stability in China. Whatever your plans are for like 24 tradings, for whatever crypto scam or whatever you want, it seems to me that there's no place for this in China.
By the way, that's another one they cracked down, crypto. When crypto started going nuts and parabolic, you said, no, that's done. Over. But
yeah, exactly.
Nobody's allowed to do it. That's another one.
Yeah, no.
You're right.
Right. No. It's quite a very interesting point you made on China. So I would suggest like maybe we move to if it's okay with you, Zoltan, on Japan.
Yeah, from one of the lower bond yield markets now in that one, which has been moving. Everybody's looking at the Japanese bond yield, so I'm having a lot of discussion with real estate investors, and most investment managers are still quite bullish on Japan because they see it as a reflation trade now. But I'm also interested, Louis, I think that what is the end game here? So it's quite frightening, the whole moves in the Japanese bond market.
Look, it's very frightening. The JGB market has been in full meltdown mode. And with that, I think, to be honest, I think it's been one of the big drivers of the push higher in yields everywhere. It's the fact that Japanese bond yields go up every day, I think, is one of the reasons why US Treasury yields are going up every day. Now, for me, the big question on Japan is now a pretty simple one. You have a yen at, above, we're at what, 162, 163. A yen that is deeply, deeply undervalued. Perhaps not as undervalued as the renminbi, perhaps not as undervalued as the Korean won. When you visit those three countries back to back to back, China feels the cheapest. Now you could say this is anecdotal evidence, but China feels the cheapest, then Korea, then Japan. But Japan is still stupid cheap. And so Japan is sort of this odd country where, because Japanese savings outside of Japan are at this stage, I think 3.6, 3.7 trillion US dollars. It's 82% of Japanese GDP. When the yen goes down, their wealth goes up because they own so much abroad. So it's kind of weird. Having said that, you now have the Ministry of Finance saying, look, we don't want the yen to fall anymore. We want the yen to start coming back up. We have all these things to fund at home. We want to refund an army. We want to refund a domestic supply chain in a number of industries. And all this is going to cost a lot of money. So pension funds, GPIF, all you guys, please start bringing the money back. Start buying our bonds and bring the money back into yen. And so that's the big quandary, because I think we're in front of a very simple decision tree. Is essentially, are the GP, and the Ministry of Finance started asking this a week ago. Is the GPIF, the finance ministry, going to do what? Are they going to do what the Ministry of Finance is asking them and repatriate money? Because if they do, who's going to be the seller of the yen? If the GPIF turns around and says, you know what? Okay, fine. I'll sell my US Treasuries. I'll come back. I'll buy 10-year JGBs. The yield is now high enough. I can immunize my portfolio at these levels. I'll buy 10-year JGBs and I'll buy the yen. That's all well and good. Who's going to sell to them the yen to do this? There's no natural seller of yen in the market since Japan now has a trade surplus, and since foreigners don't really own very much in Japan at all anymore. So there's no real natural seller of the yen. So it's a bit of a cop-out of an answer, because I'm answering your question with another question. But essentially, the quandary on Japan is, look, the pension funds have been told to bring back their money. Are they going to do it? Yes or no? If they do it, we enter into a very different world. If the yen goes up, I don't see how bond yields don't continue to go up. If the Japanese pension funds turn around and said, fine, I'll sell my US Treasuries, and because a reflating yen will be reflationary for everyone. By the way, if the yen goes up, the won will go up, the renminbi will go up. So whatever we import from Japan, whatever we import from Korea, whatever we import from the United States, from China, will also be getting more expensive. So it's a super important question. And if you ask me to say, well, are they going to do it or not? I think they will. I think they will, because Japan is that kind of society. If the Ministry of Finance tells the GPIF, hey, do this, they're probably going to do it. And the reason they haven't done it yet is they're studying how to do it without creating massive disruption in the markets. But essentially, since they've been told you have to do this, this is it a coincidence that U.S. Treasury bond yields are breaking out literally as this happens? I don't think it is.
No, you're absolutely right. What was surprising for me, it was like eye openers. Like everyone is telling me, oh, who is telling us the debt treasury of Japan is unsustainable. Yet, when you look at the shape of the yield curve, it's telling you a different story. Some bonds are trading at a premium between the 30-year and the 40-year. So the yield curve is telling you something else. So what is going on? And I think that some of the people have not seen what's going on. It seems to me that the Ministry of Finance is selling U.S. duration and shifting into Treasury bills, which is putting additional pressure, in fact, as you mentioned, on U.S. yields. And it will go on until something is going to break. What's going to happen? I don't know. But one thing I came across, which is as well very surprising, is that something I think I sent you the presentation. We discussed it a couple of days ago about 2016. It was an old presentation showing that in fact, Japanese are very good at implementing fiscal discipline. And all in all, they are very disciplined people. So as you said, if the Minister of Finance is telling the GPIF and all the lifers, you need to bring the money home, what's going to happen? Because it might happen very fast. Well, not very fast, but they're telling you there's a big shift coming up.
I think that's the big risk today. That's the big shift in markets. And yes, to your point, for all the talk about unsustainable Japanese debt, etc., to be honest, I think that was sort of one of the big stories 5 years ago, 10 years ago, 15 years ago, and people have stayed on that. Let me call it a cliche. People have stayed on that cliche, and Japan is essentially back into a primary surplus now. So it's the whole if you want to look for unsustainable debt accumulation, it no longer is Japan. Now, I never believed it was Japan in the first place, because almost all of the Japanese debt was bought by Japanese savers.
Exactly.
And my go-to line is, if I borrow $1 million from my dad, as a family, we have no debt. You net it out. And when you look at historically debt crises tend to occur when more than a quarter of your debt is held by foreigners. And you continue expanding your debt at, say, 5% of GDP. Like when your budget deficits are, when you look at your Thailands, your Argentinas, your Greece, the big debt crises, it was always a quarter of the debt or more held by foreigners, and foreigners waking up one morning and saying, wait, why do I own so much Greek debt? It's like, why do I own, like, why do I do this? Let's just get rid of it. Now, in Japan, the most Japanese debt breached held by foreigners was 8%. So if you want to look for places that have accumulated too much debt, continue to accumulate too much debt, and more of this debt is held by foreigners, there's essentially 3 countries that stand out. The first is my own, is France.
Yeah, for sure.
Where the debt accumulation is, and it's so France hasn't had a budget surplus since in my whole lifetime. The last time it had a budget surplus was in 1972, and I was born in 1974. So there you go.
I was born in 1972. So yeah, we're
so
come from the same era.
So it's your fault. Sounds like it's your fault. It all went
Exactly,
downhill. It all went downhill after you.
Absolutely.
So we haven't literally had a budget. So, and more of our debt is held by foreigners. So the first one is France. The second one is the UK. Somewhat similar trajectory. And the third is the United States. Now, I think, in fairness, all three of these countries have a sort of saving card in that when you hit a debt crisis, people wake up and say, why do I want to own Greece? Forget Greece, forget Argentina, forget Thailand. Nobody's ever going to wake up and say, forget America, right? Because, well, they can't, but also America has a lot of assets where if the US dollar gets cheap enough, people will want to buy them. Like if the dollar gets cheap enough, hey, I want a nice apartment on Central Park in New York, or I'll buy a condo in Miami or whatever else. I think there's some of that to some extent in France, in that we have a number of world-class companies, the Legrand, the Schneider, the Air Liquides, etc. We have a number of world-class companies, the LVMH, Michelin. There's a lot of really world-class companies. And there's also a price at which, Paris real estate gets cheap enough or real estate on the Riviera or real estate in the French Alps. And people are like, yeah, you know what, I'll buy that. And to some extent, the same is true for the UK. Although the UK probably doesn't have as many world-class companies as France does. It does have a lot of prime real estate that people want to buy. So anyways, all this to say that it may take more for these guys to hit debt crises because of the environmental assets that they own that are always going to be worth something.
Yeah, and when talking about the UK, I would be a little bit more scared than France because of the fact that 25% of the UK debt is linkers. So they have a lot of convexity. What saved what saves their position until now, the fact that the duration of United Kingdom debt is about the double of that of France. So, but the convexity issues coming from linkers is a very big sword of Damocles in a inflationary environment to the like we're seeing right now with rising oil prices again. So this could be very precarious for the new Prime Minister of the United Kingdom, in fact.
Yeah, I think the UK also had the big comparative advantage of the UK was selling overpriced London real estate, mostly to Western Europeans who were moving to the UK as a tax dodge. Or maybe tax dodge is too strong a word, but I think if you were a rich European and you didn't want to pay high taxes in France or in Sweden or wherever else, or Holland, you moved to the UK, to London, and it was a fun place to live because you had all the other rich Europeans and you had great schools and you could make your house there. But I think essentially by getting rid of the whole non-dom rule, they've now killed the high end of their real estate market in London, which was how they squared the books. They squared the books by selling high-end real estate in the UK to foreigners.
Yeah. It looks to me like they've killed the golden goose. They've killed the golden goose.
So you take that away.
What we see now,
you take that away. It's like it's now they still have some. So they have world-class banks. They still have the City of London. They still have a lot of things. But what's the asset? If I'm a foreigner, if I'm French, I am a foreigner. If I'm French, it's like, what asset in the UK am I going to be like, oh, you know what, that's cheap enough and I want this?
Yeah. And it's quite interesting to see that Italy has capitalized a lot on this, because the real estate prices in Milano, for example, have gone through the roof. And you had like a lot of private equity asset managers relocating their offices for tax purposes in Milan. So they have the best of the world. They have a great location, amazing Italian lifestyle, much better than the British weather. So it seems to me that Meloni is a winner in that game so far.
Yeah. No doubt. So, but sorry, I sort of shifted the conversation from Japan. I apologize. But I think Japan is a super important piece in the puzzle. To come back to it right now, I think we can't underemphasize how important a piece in the puzzle. I think this shift in Japanese policies towards telling the pension funds to repatriate is super bearish bond markets everywhere. And I think it's what's driving right now the sell-off in bonds. I mean, look at US Treasuries, right? We've just gone from 450 to 470 even though we just had a CPI print, what was it, a week ago, the CPI print? We had a CPI print that was, I think, the biggest surprise, negative downside surprise in CPI, if you exclude the COVID period, which is like where the data got all funky. If you exclude the COVID period, I think it was the biggest downside surprise since 2011. So you would think that the bond markets would be like, okay, inflation's rolling over, happy days, let's buy bonds. And boom, you move from 450 to 470.
It's huge.
So what's driving? And by the way, it's not like, oh, well, it's only 20 basis points. We had bounced on that 450 level for like a number of times, and now we've broken out. And so it's a little bit like, okay, what drove this? It wasn't really any US data per se. We had the downside surprise on inflation. Most of the recent US data has been somewhat soft. It wasn't corporate earnings, Tesla disappointed, Google disappointed. It's not the stock market, which seems to be, bouncing along. So why are bond yields breaking out to the upside? Now you could say it's energy, for sure. That's a big factor. The fact that the Strait of Hormuz seems to be back on, that oil is back at $85. But then again, $85 is where we were 3 months ago. So no, look, I think for me, it's partly energy, partly Japan. These are the two huge pieces in the puzzle, and maybe it's also you mentioned how Baba's up 25%, how Hong Kong's bouncing back after a terrible quarter. 120 billion left Hong Kong, and now money's coming back into Hong Kong. So you add these three things. If money's now coming back into China, money's coming back into Japan, and energy is going to cost more, it's going to be a tough environment for bonds.
Yeah, absolutely. I think as well, people haven't realized, but Bank of Japan is doing very significant quantitative tightening. So it means that somewhat they are really selling duration, meaning that they are putting pressure on the long end of US bonds for sure. If you look at investment grade, for example, you've been much better off to avoid the volatility being in the 1 to 3 years bucket. Otherwise, you've been smacked around all year long because of volatility because the volatility in the bond market. So you don't want to be long duration in that environment because you get taken to the cleaners because of convexity. You get whacked.
Yeah,
whacked.
You've been being slapped around with essentially nothing to show for it. And I would say, look, for me, bonds. I like to say that building a portfolio is like building a rugby team, where you need things of different shapes and sizes, people who have different jobs. So, you have guys out on the wing who run really fast. You have props up front who are not so tall and really, really big and really, really strong, and you ask them to push in the scrum. And for me, the bonds have always been the prop of a portfolio. They're there to protect you when everything goes wrong. They're the foundation on which you build the rest of the team. And what's been fascinating to me in the past 5 years is that bonds have essentially stopped doing their job. The bonds' number one job is to diversify your equity risk. When equities go down 10, 20%, you want your bonds to go up. I mean, that's their number one job. And the reality is that if you look at the past, since COVID, every 10% drawdown, bonds go down as well. So increasingly, they add volatility to your portfolio rather than reduce it. And they don't do their main job, which is diversify your equity risk. And so it's
quite
like,
interesting
why
what
am I
you're
owning
mentioning. Yeah, because it seems to me that if you look at what's been very interesting in 2025 and even in 2026 is the outperformance of emerging market equities as well as emerging market local currency bonds. So it's been much better to play the diversification theme and to be going outside the US to have better performances in both equities and bonds, which is quite surprising. For so many years, the US has been leading the rest of the world.
And what's fascinating is, against a backdrop, I think it was Bruce Kovner of Caxton that said that he's looking for things that everybody believes in and the market doesn't confirm. And today, everybody in the market believes U.S. exceptionalism, you have to be overweight the U.S., it's the only place you can outperform, etc. If you look at since Trump was elected, since Trump was sworn in, U.S. equities have underperformed Europe by 12%. They've underperformed Japan by 17%. They've underperformed emerging markets by like 22%. And on the bond side, US Treasuries have underperformed every bond market, like every single one. They've underperformed, and the one they've underperformed the most is emerging markets. And I think behind that lies a simple reality, and that simple reality is that it's the old saying of, you don't make your father's mistakes, you make your grandfather's mistakes, because you saw your father and you're like, oh, I'm not going to do this. And so you make your grandfather's mistakes. And I think when you look at policy making, when COVID came, even through COVID, even afterwards, you had the Fed, the ECB saying, oh, we want more inflation. Oh, we want, we need to have more inflation. And if you're a bondholder, like, why would you stay there? Like, if the central banker of the currency that I own tells me I want more inflation, I'm like, thank you, check, please. I'm out. Like, no interest. Like, what's my upside?
Yeah.
And meanwhile, in emerging markets, they did the opposite.
Mm-hmm.
Like, if you were in Brazil, if you were in Mexico, if you were in Chile, you're like, inflation? No, thank you very much. I know what inflation was. I had it in the 80s. I had it in the 90s. It was pretty freaking horrendous. I want no interest with that. And so the best performing bond markets in the past 5 years have been places like Brazil and like South Africa, which
absolutely. And in terms of real yields, it's fantastic what you're getting out of Brazil, because you have inflation around 4.5%, and you have yields, net yields around 10%. You can sleep at night with this. You can sleep, no problem.
Of course.
It's also what we have discussed on our last call, Martin.
Absolutely.
But also coming back to this safe haven, so in terms of portfolio construction. So in my discussion with some family offices in Switzerland, it's like gold has taken that place. But Switzerland is also special because we don't have a yield anymore on bonds. But so gold is also paying into your thinking with the quadrants, actually.
So gold is a tricky one. Because, everybody says, yeah, gold, sure, but it has a much higher volatility. It has much bigger downside. We just saw this in the past 6 months, right? It has much bigger downside than bonds. It adds volatility to my portfolio. It's not perfectly negatively correlated to equities. And so it's not like you can just switch from one to the next. Unfortunately, bonds were awesome for 40 years and they're just not. And it's a little bit like, the way I put it, sorry to mix up my sports analogies, but it's a little bit like when Michael Jordan retired from the Chicago Bulls, and you're like, yeah, you know what? That next guy who's taking his place, he's not as good. And it's like, yeah, you know what? You had a Michael Jordan. It's a generational talent, and you were lucky. And it's very hard to replace. And bonds were that generational talent for 40 years, and now they've retired. And so you've got the choice of either playing Michael Jordan at age 45 years old, which doesn't work, or you got to look for something else. And you can't replace Michael Jordan with one player. I think you got to replace him with several players. So what you do in a portfolio is gold is part of that replacement, but it's only a part of that replacement. And I think the other part, to be honest, is energy, which incidentally has been a better portfolio diversifier in the past 5 years than gold. And few people realize this. I just wrote a piece on this. The best performing sector for the past 5 years is energy. It's actually outperformed tech in the United States. It's the best performing sector for the past 5 years. And it's 3% of the S&P 500. Tech, meanwhile, which is the second best performing sector, has gone from 25% to 40% of the S&P 500. The reason for that is, and energy has gone from 5.5 to 3. Now, how could that be? Because you've had shrinking share counts, because you've had mergers, because you've had company not issuing capital like they used to. And meanwhile, in tech, you've had a lot of issuance. Obviously, the SpaceX IPO, we mentioned the Google share issuance, et cetera, et cetera. So all this to say that I think you mentioned our 4 quadrants. The way we look at the world is we say, look, economic activity and inflation are what drive asset prices. That gives you 4 investment scenario: a deflationary boom, a deflationary bust, an inflationary bust, and an inflationary boom. We are today in the inflationary part of the quadrants because of fiscal policies, because of monetary policies. We are in the inflationary part of because of trade policies, because of wars. We are in the inflationary part of the quadrant. And when you're in the inflationary part of the quadrant, bonds don't diversify anything. And instead, your portfolio should be 60% equities for the inflationary boom part, 20% metals, also for the inflationary boom part, and 20% energy for the inflationary bust part. So if the old portfolio was 60 equity, 40 bonds, the new portfolio, and I wrote a book about this in 2021 called Avoiding the Punch, which is available for free on our website. The e-version is available for free on our website.
We'll put the link. We'll put the link in the description of the video later on.
So it's the new portfolio is 60 equities, 20 energy, 20 metals.
I also wanted to pick up your thoughts on this, because I do follow as well on top of Gavekal, Jeffrey Gundlach, and what was very interesting what he said this year, which came to me as a shock, because he said, okay, if you wanna in your equities allocation, you have to be 100% outside the US. That's what he was recommending. And I was like, wow, this guy is a US portfolio manager. He has like global asset allocation mandates, and he's recommending and he's saying online, 100% of your equity exposure needs to be outside the US. I was like, what's going on?
So look,
what are your thoughts on this?
I think Jeff Gundlach and Double Line have a history of making very courageous bets. They have a history of, they've built a massive firm, a super impressive firm, on the back of taking courageous stance. I don't know. I know Mr. Gundlach, and they're a client of ours. And whenever I'm in Los Angeles, I meet with them. It's a super impressive firm, and I don't obviously know the details of their investment process. But what I find fascinating in Gundlach's call is he's actually partly, everybody's like, oh my God, how can you say this? US exceptionalism, etc. But he's actually reflecting the momentum of the past 2 years.
Yes.
If you look at the past 2 years, you were better off being abroad than in the United States.
Absolutely.
You were better off. Now, few people realize this. Obviously, he does, because he lives and breathes the markets. So he sees this. He knows this. And he knows that it makes sense on a valuation point of view. He knows that it makes sense on an investor positioning point of view. He knows that it makes sense probably given underlying fundamentals. And it makes sense given the current momentum. And so when all the signs point in one direction, I think he has the courage to say, you know what, all in, let's go. So that's how I read this call. And to me, it's a call that makes perfect sense.
Yeah, it was very, very impressive to hear someone who's followed by a lot of people coming out of the wood like that, going really, really against everyone. The consensus has always been, you can't be outside the US. US is the biggest market in the world. No one can avoid being invested in the US. It's the only market that counts. And when you think about it, actually, it's true, but it's kind of scary when you think about the net investment position of the US, which is now 90% of GDP. It's very fragile, because if no one goes into bonds and all the flows are going into equities, And you have such a concentration in the markets now in the US, which are similar to what you're seeing sometimes in emerging markets like Brazil, when you have high level of concentration in emerging market indices. And you see as well the rise in active management with all, passive management, with all these ETF, and everyone is following the same trend, following the same stocks, following the same exposure. And as you mentioned, hang on, 40% of the US stock market is in tech, only 3% in energy. What am I doing wrong?
No. I think the perception of everyone out there is I'll buy the S&P 500 and I'm buying a diversified portfolio, but you're not. You're not buying a diversified portfolio.
Yeah. Good. I think I could listen to you the whole day, Louis, but I'm also thinking about your time budget here, and I don't know, Martin, if you have a final question or should we wrap it up
I wanted
here?
I wanted to thank Louis-Vincent very much for this exchange, because we live in, as we say, in very interesting times for sure. And I think that Bondzilla, the bond monster, is made in Japan. Given the exposure of Japanese investors to US credit markets as well. I was reading a couple of years ago a survey by UBS, and they were reckoning that something like 12% of US credit markets have Japanese investors. So if indeed GPIF gets its marching orders from the Ministry of Finance of Japan, in terms of allocations, we're going to go through some very interesting times. I don't know what Louis-Vincent wants to conclude on that or not, but yes, it's kind of scary what we're looking at.
I'm going to conclude that I hadn't heard Bondzilla before, actually, and I love it, and I'm going to steal it.
Great, because I think it's a great characteristic. I think Bondzilla is made in Japan and is the biggest beast in the world when it comes to allocation.
No, I love it. I'm stealing it.
Great.
Thank you very much.
Many thanks.
Thank you so much for your time, Louis-Vincent. Much appreciated. We will obviously put the links to Gavekal Research as well, a link to your book into the conversation below the video. Thanks for your time again.
Thanks again, guys. Appreciate it. Thanks again for having me.
Thanks. Bye-bye.